Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia. This evening, once again, I'm joined by my brother Brian and partner at As Good as Gold.
Good day, Darryl.
And this evening, we have a very special guest. None other than the author of The Coming Bond Market Collapse. He's the president and founder of Pento Portfolio Strategies. He is a globally renowned economist and has been a regular guest on CNBC, CNN, Bloomberg, Fox Business News, and numerous other international media outlets. Welcome, Michael Pento.
Thanks so much for having me on the show, guys.
Oh,
Not a problem.
Thank you so much, Michael. It's been, I can't believe it, but it's been 2 years. 2 years since we last had an interview. And a lot
and nothing at all has happened in those 2 years. It's amazing.
Oh, yeah. No, I would tend to contradict that. I'd say there's a great deal has happened over the last couple of years, but a lot of water flowing under the bridge. But what I would say is this, that there would be a lot of people out there at the moment that would probably be surprised by what's actually taken place over the last couple of years and the position we're in right now. But I would tend to disagree with that line of thought. I think it's inevitable where we are right now. And I liken it a little bit to what Jim Rickards used to say, and probably still does, but he referred to a snowflake that would land on the side of a cliff, on the precipice, and that would cause the avalanche. So it was just that snowflake that would do it. And so what have the governments and the central banks been doing since the GFC? Not a lot, other than create stimulus packages, throwing money at the system, printing currency, lowering interest rates, and they've run out of bullets.
Yeah.
Basically, that's what's transpired.
And the snowflake is basically the virus, the coronavirus, is really
that's right.
pushing it along.
And it could have been anything. It could have been increased tensions in the Middle East. It could have been anything, but it just happened to be coronavirus. So the world at the moment is in a very vulnerable position. So I guess the first question I'd like to ask you, Michael, is this, and it revolves around a comment that was made by our Prime Minister, Scott Morrison, only yesterday. And he said that the world economy is expected to shrink by around 4.5% this year. To put this into perspective, during the GFC, the world economy shrunk by 0.1%. So they're expecting it's 45 times the impact on the economy, one could suggest. So my question's got to be, how does one assess that and determine the ramifications in the process? I mean, this is really scary stuff, isn't it? Because the GFC had a huge impact on millions of people's lives. And now we've got a situation where it could be that the expectation is 45 times more serious in real terms.
Okay, so, while GDP is shrinking in a greater extent this crisis than the great financial crisis in 2008, what's important to understand is that the trajectory of debt has been rising exponentially. It's been rising exponentially as compared to the contraction in global GDP. So if you look back all the way to the end of World War II, and you do a trajectory of the debt, it is rising in nominal terms incredibly faster than GDP. And that ratio has now, in the United States, let's just talk about the United States because I'm not as familiar with the debt in Australia, but we're now approaching 140%, if you include intra-governmental debt, 140% debt to GDP. It's the highest it's ever been outside of immediately after World War II. And it's going much higher than that, by the way, gentlemen. So yes, GDP has remained stagnant, and it takes many more dollars of borrowing to create a dollar of GDP. In fact, if you look at debt globally, I can't speak of that, we're over 300% global debt to GDP ratio. And you have to lug around all of this debt, which is, what is it? When you can boil it down to one economic function, it's a productivity killer. Okay, when you are desperately trying to monetize debt and pay off debt, and all of the debt that's borrowed is borrowed in an unproductive capacity. In other words, for consumption, not for capital goods expenditures, this is the problem you get. And here's the thing, gentlemen, I'll try not to be too long in my answers, but your audience should understand this. It's very clear that you cannot pay back this debt by normal means of growth. It's beyond that by many, many miles. Many factors. You can no longer grow your way out of it. And the funny thing is that let's just take the United States, for example, again. Look at business debt in the United States. Business debt is now 90% of our GDP. 17.5 trillion, that's total non-financial business debt. We just had the Z1 that came out a few days ago. So this is the Federal Reserve's data. It's not data that it's not fake news. Unfortunately, I wish it was fake news, but you have business debt that's 90% of our GDP. This is insolvent debt. And gentlemen, when you have insolvent debt, what should your borrowing costs be doing to compensate or to offset for that debt? Your borrowing costs should be surging. But the exact opposite has occurred. Through global financial repression, borrowing costs are now, we have $15 trillion worth of negative yielding debt globally. So you have this anomaly of insolvent, massive amount of nominal debt and debt to other underlying ratios such as GDP. And you have at the same time record low borrowing costs. And the only thing that's keeping this mirage together, this kind of semblance of solvency together, is record low borrowing costs provided by central banks. And here's where this whole thing really should scare the living daylights out of you, is that what is it that enables low interest rates other than central bank repression is disinflation and deflation, the way central banks measure it. But what is it that central bankers are trying to pursue concurrently, in unison? Intractable inflation. They are trying to get inflation inculcated globally to reach some level of 2%. In the United States now, by the way, gentlemen, it's now 2% plus for a number of years to make up for the times it was below 2%. And I'll end my answer with this. What central bank on this planet has ever been able to control inflation with any degree of success? And I'll answer my own question. Zero.
No.
There has never been an occasion where central bankers have been able to engender a specific target rate of inflation. Back in the 70s, we had an inflation rate that was low single digits, shot all the way up to 20% by the early 1980s, 1981. And, so that shows you that when the Fed finally, or any central banker finally engenders their inflation, it doesn't stay there and goes away. So they couldn't achieve their inflation targets before this new target was announced, 2%. They couldn't reach 2% right after the great financial crisis till today. Really, it was an unachievable target. But once they get there, watch out.
I saw you being interviewed about a month ago, Michael, and you said the portfolio that you're running is long 20% in precious metals, and the US had a debt of 850% of revenue. Now, do these two statements have any correlation to one another? And the way I see it, the more debt you have, the more gold you should have.
Yes, yeah. If you put up a chart of debt to GDP ratios, and then you look at a chart of gold, there's a high, the R squared or the correlation there is very high. So right now, if you look at this fact, we have, as I just mentioned, about 140% debt to GDP ratio. But what I don't look at debt to GDP, because you cannot say to your constituents, I am going to tax you 100% of your production for the year. So your tax rate's going 100%. So go out and have a nice day at work. That doesn't really work. I look at debt to revenue. So now our debt to revenue is now about 900%. So 900% is our debt to revenue. And You think about that, you say, well, you can never pay that back. But it gets worse. We are adding to our debt in the United States to the tune of over $3 trillion. So the annual deficit is, get this, gentlemen, 15% of our GDP. So forget about paying off the debt. You can't barely even service the debt the way this thing is going, the way this trend is, this vector is very, very scary. And you're adding to it over $3 trillion in fiscal 2020, which ends, by the way, in October 1st. This is the last month of our debt. We will be over $3 trillion, and our deficit, as you said, is over now 900% of our revenue. So you think about that. If you had like a $100,000 income, and you have a $900,000 mortgage, and forget about paying off that mortgage, you're adding to that mortgage 15% of your income.
All right, so keeping that in mind, okay, for a long period of time now, the US dollar has been considered a safe haven investment. So based on what you're suggesting right now, I'm guessing it's not. And the second part of the question is it possible that the US dollar could lose its reserve currency status?
Okay, so anything is possible. The US dollar is in the process of losing its world reserve currency status. You have a lot of Asian bloc nations are now devising plans to trade their commodities in something other than the dollar. If you look at Australia, Australia's fate is very much tied to the success of China. And China, as my friend David Stockman says, is one giant Ponzi scheme. In fact, their borrowing makes the US look fiscally responsible. So what does this all mean when I talk about all these ratios and debts? What I'm trying to paint a picture is we must now, we being the global central bankers, I'm speaking in their train of thought, they have now resorted to one thing: massive debt monetization. That's their answer. And it's not exactly that they're worried about doing it. They're encouraging this debt monetization. In fact, the United States are actually buying, junk bond ETFs. So they're encouraging this debt monetization for the goal of higher inflation. And when you add insolvency, the insolvency picture we just talked about, to record low borrowing costs that have been, the lowest borrowing costs in the history of mankind. In other words, you defer your consumption, okay, that's savings, deferred consumption. You save your money and you're guaranteed to receive less when you get your principal back, never mind inflation. And then you throw inflation into that picture. That's a very volatile cocktail, which is that's the real, I call that the genuine crisis. The real crash is coming. And it's this: it's the inflationary and insolvency implosion of the global bond market. You held up that book. That book is outdated. I wrote it in 2012. The concepts are still very relevant, but the data, it really needs to be updated, because when I wrote that book, I never dreamed that sovereign nations would put into place a case where you would get negative return by lending the government money, but that's where we are. Yep. So it's an inflationary and insolvency implosion of the bond market. And then when you think about this, gentlemen, let's just say we have a condition where we have engendered 2% plus inflation, and it's going to 3, 4, 5. By the way, I'll just hasten to add that when the U.S. Federal Reserve measures inflation at 2%, it's closer to double digits, but easily, okay, because they measure it using the core PCE price index. So when you have inflation that high and the bond market starts sniffing out that the Fed's going to start raising rates, and then that is when the bond market absolutely implodes. And what do you think that's going to do to a stock market that is completely divorced from reality? Where now in the United States it's trading, I used to think 150% was like, 1.5 times GDP. How could you ever have a stock market like that? The last time that was the case was in March of 2000, before the NASDAQ fell in the next 2 years by 83%. What happens when whoever's the Fed chair at the time has to take interest rates, borrowing costs, forget about your 2.75% jumbo 30-year mortgage rate. When your borrowing costs for your mortgages go, in double digits, and the sovereign yield goes to double digits, and your stock market is at 180% of GDP. I mean, the carnage that's going to result from whenever they have their inflation successes is going to be something like we've never seen before, which would, I think, dwarf what happened in the global Great Depression in the 30s.
Yeah. Well, I know. Look, that pretty much falls in line with Frank Geistra, who just recently stated the winners are going to be gold and commodities, not bonds, not cash. Who'd want to buy bonds at zero interest rate with no returns? I mean, this is what you're talking about. I mean, and who would? So where's the future for the bond market? I mean, how long do we have to wait before it just, no one invests in bonds anymore, US bonds?
Well, as I said, so when the United States Federal Reserve inculcates, in other words, when it teaches people, this is what they want. This is not what I want. This is what Mr. Powell et al. At the Federal Reserve want. They want you as a consumer to have in your mind that inflation is ingrained in the economy. It's going to be at least 2.5% for quite some time, and then it's going to be rising from there. So if you're absolutely convinced that the nominal yield on the US Treasury should be at least 2.5%, 3%, but is currently yielding 0.6%, what would you do? You would panic out of bonds, send that rate soaring, because don't forget, you are now, as an investor, this is why, by the way, I own bonds. I'm actually long bonds right now on the very short end of the curve, because I think we're in a disinflationary environment until we actually, and I'll get into that in a second because it's complicated. I run a model called the inflation, deflation, and economic cycle model. And we just borrowed $3.3 trillion and monetized all of it. And then now all of that's going away. So we're going to have a disinflationary, or if not deflationary cycle in the United States for at least another few quarters, in a couple of quarters, until they start doing this, what I think they're going to end up resorting to, no matter what party wins, is probably going to be forced into some kind of universal basic income. That's how you get your inflation, by the way. That's how you finally get, don't forget, like I said, after the Great Recession, we didn't have hyperinflation here in the United States. On the consumer level, we just had it in the stock market. Well, if you want to get inflation really going, what do you need to do? You need to think of a scenario. I'll pay people $100,000 a year plus to stay home and lay fallow, don't produce any goods and services. I'll give you the money and I'll have our central bank print it all. You'll get your inflation. And when you get your inflation, what's going to happen is people right now, like me, are trying to front run the Fed's bid. What is the Fed doing? They're according to Mr. Powell, he's printing $120 billion a month and buying treasuries and mortgage-backed securities and junk bonds. Okay? That's what he says he's doing. So I'm front running him. We still have disinflation. I'm front running the Fed's bid. But what happens, gentlemen? What do you think happens when the Fed says I'm going to have to remove my bid and start to sell bonds? That's how you raise interest rates. You sell bonds, drain liquidity, and then you have Wall Street tripping over themselves to get ahead of that by selling all of their bonds. Well, you're going to have a bond market plunge and yield shock like we've never seen before. That's what's happening. That's what I model. That's what I'm protecting against. I'm not a static investor. I don't say someday this is going to happen or someday that's going to happen. No, I want to know the cyclical nature. In a cyclical nature, what's the second derivative of inflation and growth? Where are we headed? And in that way, I try to protect and profit no matter what the cycle is.
Oh, that's an excellent answer. It does explain a lot. My next question is going to be on the subject of inflation, and to carry on from when we were talking firstly on our first question. But I wrote it out saying basically the US Federal Reserve continues to say that they haven't been able to get inflation above 2%. This sort of number really irks me, and I'll read on. But when you look at the present definition of inflation, you can actually, it differs from the mid-80s definition. Obviously, when food and energy are taken out, it changes the method of measurement. What do you think, Michael, is the inflation figure, real inflation figure, and has it presently flown into the stock market and the real estate markets in the US as it has in Australia?
Absolutely. So first of all, inflation is different for everybody. You know, do you have kids that attend college? You know, are you retired? Do you own a house? Are you renting? So it's different for everybody. So with the Fed, but with the way the Fed measures it is, like I said, it's the core. So core meaning X food, X energy. So X things that are actually rising. Okay. And it's also called the personal consumption expenditure. So this particular index is the most bastardized of all of them. It has the most hedonic adjustments, and the most substitution adjustments. Okay, so here it is, and this is and I mentioned exactly this before. If you have a 2.5% reading on the core PCE metric, your real rate of inflation is double digits here in the United States. And the reason is, I want to expand on that a little bit, is that if you took in asset prices, bond prices, home prices, the way you're supposed to measure homes, not by the owner's equivalent rent, but by what actually is happening in home prices, tax increases, the value of assets on the New York Stock Exchange, on the NASDAQ, FANG stocks. I mean, your inflation this is what happened right out of the Great Recession in 2008. So you had an expansion of about $3.7 trillion to the Fed's balance sheet. That's how much money they printed. They gave it all to Wall Street. None of it went to, it didn't go to an individual and say, oh, you're having trouble with your mortgage payment? Here's a check. Here's a check. That's what we did this time. The last time we gave the money to, BlackRock and said, here, go out, here's your, or more Wells Fargo, or, you name the bank. Let me have your bad asset, your bad mortgage-backed security, and you go out and gamble with it. You go out and gamble with that money. You don't have to loan it out to a consumer that's really hurting. Why would you take that chance? Go and buy more bonds. Go and buy stocks, because that's what that's the asset inflation that we're targeting. That's what happened. The only difference between this recession and the Great Recession is that instead of just bailing out banks, which we did that again, absolutely, we actually sent money through helicopter money, actually send checks to consumers and businesses, grants, not loans, grants to businesses, which kept them, personal income soared. You shut down the economy, you had 30 million people unemployed, collecting a check from the government, and their income was soaring, because you pay people more than they would be making, a living, gainfully employed. And then you also sent them a check for $1,000 per adult and $500 per child if you made less than 200,000, 198,000 married, filing jointly. So most Americans received those checks. So that's, by the way, and this is why I'm now hedged for disinflation. So $3.3 trillion borrowed and printed by our government, and now all of that has gone away and is almost going away and almost completely gone. And on top of that, you told the American consumers, you don't have to pay your credit cards, you don't have to pay your student loans, you don't have to pay your car payment, and you don't have to pay your mortgage. It's called, foreclosure forbearance. That is also ending right now as we speak. So that's the big problem. Oh, did I mention the fact that we might not have a president of the United States? You talk about the dollar. I don't, it's funny thing is, and I don't have all the answers. This might surprise you, but I do know history pretty well. And the history shows clearly that during times of acute global stress, the dollar has been the major recipient, and short-term treasuries have been a major recipient of that chaos. That's a fact, gentlemen. But here's the problem. Here's the issue. If we have another relapse, a second recession here in the United States, which I think is very, very likely, and it's accompanied with the fact that we don't have a clear winner, we don't have a president, maybe not even until January 20th. Does the dollar then, instead of become a recipient of that chaos, do people flee the dollar? That's a real elevated risk. And by the way, the dollar can rise while gold is increasing. They are not mutually exclusive, because what does gold most care about? What is gold? Gold is money. So it competes with dollars. If your dollar is getting almost 0% interest, and when you adjust that rate for inflation, it's negative, and that rate is falling, you'll own gold regardless of what the dollar is doing. There are plenty of instances when the dollar is rising, when gold does very well. But the sweetest of all sweet spots for the precious metal, for AU, is if you have falling real interest rates and the dollar is also falling as well. And that is a very real possibility starting November 3rd.
Do you see a cap being put on interest rates? You've mentioned this before. And you've said that if the Fed put a cap on interest rates, that would send gold into the stratosphere. Do you think there's a lot? Sorry, what was that?
I said thermosphere. You just made it stratosphere.
Wherever. Do you think that there's a likelihood of this event taking place? And if it did, how quickly would gold react to that? Immediately.
Please quote me on that. Immediately, that would be the case. So here's what I think could happen. So we saw in March what happened when the MOVE index, was the volatility index on treasuries, spiked, and the yield on treasuries started to soar. Gold did not like that very much. So that's a signal of, hey, sell everything that's liquid and go into short-term treasuries. So in the short term, what could happen is, if that was the case again, I expect the same scenario to temporarily hurt gold. But then if the Fed was to say, listen, we cannot, and this is very, very likely, this is not a quixotic fantasy on your part or my part, because I don't fantasize. I just want to make money. I don't sell anything here. I just promote profits for my clients. That's all I care about. So what could happen in the short term is gold could get hurt. But then if the Federal Reserve says, hey, given our 900%, our debt as to a percentage of revenue, and given the fact that our high yield market is now yielding so low, junk bonds are so low that they actually yield where the Fed funds rate used to be. And if sovereign rates start getting out of control, say 2.5%, 3%, and junk bonds would then be 5-6% and heading much, much higher. Forget about 5-6%, maybe 8-9%. Forget about what I just said, 5-6%, maybe much higher. The Federal Reserve might say, we are not only just capping sovereign debt, we're going to cap junk bonds. Yeah. And the reaction then would be, this was the calculation on Wall Street, would be this. They are now going to do what? They're going to cap nominal rates across the spectrum of fixed income, okay? And they're going to do it by monetizing debt, which is inflation. So the calculus would be for much lower real interest rates. And I think gold, whatever kind of distress it was experiencing temporarily, would be the super V-shaped recovery that Donald Trump has been talking about the economy. No, there would be a super hyper warp speed, faster than a vaccine, rebound in gold, and it would blow through record highs like you've never seen before. Because once you get into that trap of I'm capping nominal yields through inflation, then it's a prescription for a weaker dollar and falling real yields, which I just said is the absolute sweet spot sending gold to the thermosphere.
Right.
Well, I congratulate you, Michael, because you're giving some great answers, and especially the one on real inflation that we've just covered with the answers that we've had. I've always said that the inflation is much more than 2%, and when you take out food and energy and you look at the stock market, look at the real estate market, yes, there's inflation, but you just got to look at the different areas where it comes in first. With my last question, it's a very, very quick one, is that I hear a lot of interpretations on where people should store gold or silver. And I of the opinion you should have it as close as possible to yourself, because I don't see myself going to Singapore or whatever, trying to arrange a loan, my gold to come back when they come running down the street with pitchforks. But what's your feeling?
You and I are simpatico brothers. I mean, maybe we're triplets then, I guess, because You just took the words right out of my mouth. I mean, why do you want to own gold? Because you don't trust the financial system. And I mean, this is the analogy. It'll be old news for people who listen to me all the time. But I don't want to call up Hong Kong when the dollar's collapsing and the world's in chaos for whatever, maybe another world war, or you have a collapse of the global financial system. Banks are collapsing. I don't want to go anywhere that I have to call up, say, hello, Hong Kong. You remember the gold you have stored for me? Can you send it to me? I mean, could China then just say, listen, that's our gold. That's our gold. Any holder of a U.S. resident that owns that gold is ours. That could happen, and that all of your gold is gone. I always start with this, gentlemen. 5% of your net worth should be physical gold that is stored where you don't have to rely on a third party to get it. Period. That's where I start with my ownership of gold.
Okay. Thank you, Michael.
Right. I guess it gets back to, and it's been supported today by Michael, it really gets back to what Jim Sinclair said. No, really, it does. What you've got to do is become your own central bank. Yeah. That's what you have to do. I mean, the central banks hold gold for one reason: power and influence. And you've got to have some of your own.
Yep.
Power and influence.
Have it close by.
Yeah, have it close by. I'm sorry. No, you go right ahead.
I'm sorry. I'll make this very short. The arguments against gold have always been that it doesn't earn any interest. Well, you know what doesn't own any interest anymore either? Your money in the bank.
No.
Your money in treasuries doesn't own any. So you could take that right out the window. So why would I not want to own gold? Gold is the one thing, not Bitcoin. It's not I call Bitcoin a glorified barcode. I'll get a lot of hate mail, maybe not from your audience, but anybody else's. A lot of people who own gold are also fans of cryptocurrencies. I like the concept of cryptocurrencies, but it's just not gold. 5,000 years of U.S. existence of history shows what do I need to own to maintain my purchasing power and my standard of living is I have to own gold. And in an environment where central bankers have ensure that you don't have any lost opportunity costs, and they're all headed for one goal, which is intractable inflation. Why would you not want to own some gold in your portfolio? It's amazing to me. And I think maybe Wall Street. You had Warren Buffett, who has never liked gold, who's always loved banks for the first time. I mean, they say old dogs can't learn new tricks. Well, this one learned a trick, and in his 90s, and he said, you know what? This doesn't make any sense anymore. Why am I storing my liquid cash in an asset that doesn't yield anything and is being debauched by a central bank? Why not take it like you just said, Rickards, Pento? We all agree that you can become your own central banker. Go off the fiat currency standard and get yourself some gold. That to me is an absolute no-brainer. And I don't sell gold here. I'm just interested. I'm interested in one thing: having my clients preserve their standard of living and purchasing power throughout their retirement, and even have it increase.
Yeah.
Okay. Not decrease, increase. So that's my goal, and gold is a part of that picture for sure.
Yeah. Look, it supports very much our lifetime mentor Peter Daniels' comments, and Peter would always say he's 84 years of age today, and he is a billionaire with a B. But Peter has always said, "I do not care what happens, what poorly executed economic decisions are made in the world tonight, because tomorrow I'll still be able to party." Because he owns precious metals. He holds something of real value. And something else he said, which leads to our close this evening, because I think we've taken up as much of Michael's time as we've
got some good answers. Yeah.
But he also said, surround yourself with people that can assist you economically. And he was always able to do that, of course. And tonight we've got our viewers and our subscribers have an opportunity to take advantage of what Michael has to offer. And I know that at Pento Portfolio Strategies, there's an opportunity there for our viewers and our subscribers to connect, take advantage of the opportunity of connecting with somebody, in this case, Michael Pento, who can assist them with their strategies, take them to the next level. But they've got to know how to do that, Michael. What is the process? How do people make contact with you so that they can move forward and gain some of the benefits that you have to offer?
Just to show you how much I like you gentlemen, I'll tell you that citizens from Australia, for some reason, cannot become clients on the Charles Schwab platform in the United States. Go figure that one out, I mean, Australia is not Kazakhstan, so I don't, or, one of those scams that you pay but that's the fact. So I just like coming on your program and informing, your audience. So what they could do is come to my website. It's pentoport.com. Email me at mpento@pentoport.com. You can call the office here at 732-772-9500. What I can offer them is I do have a podcast, and they can absolutely subscribe to that. So for under $50 a year, $49.99, you can get my thoughts, my economic analysis, and data that you won't find anywhere else, really, promulgated on my midweek reality check. If get 52 of them for under $50. So
that's what I call real value.
Oh, absolutely. Yeah. I mean, what an opportunity.
Yeah.
And we've got wonderful support from our subscribers and our viewers, our clients, and I think that's an offer that's too good to refuse, really. I mean, why wouldn't you do it? So, look, Michael, thank you so much for your time tonight. Really appreciate it. You're wonderfully supportive. So I thank you once again, and to our viewers and our subscribers, of course, who support this channel so well. Appreciate them as well. Until next time, stay well, stay focused, and goodbye for now.
And goodbye for now.